Is Wall Street rigging the system and leaving millennials behind on purpose? In this video, we're breaking down why financial institutions are making it harder than ever for millennials to build wealth, and more importantly, how you can fight back with smarter money moves, powerful tools, and a new mindset they never saw coming. Before we flip the script, make sure to like, subscribe, and tap that notification bell, because knowledge is power, and this is where your financial comeback starts. From student debt traps to housing market madness, it's no accident millennials are feeling squeezed. But there is a way to beat the game. You just need to know how it's really played. The housing market manipulation. Wall Street firms have fundamentally transformed homeownership from a basic American dream into an investment commodity. Private equity giants like BlackRock and Invitation Homes are purchasing entire neighborhoods, converting single-family homes into rental properties. They're outbidding regular families with cash offers that are impossible to compete against. This artificial scarcity drives up both home prices and rental costs, creating a perpetual cycle where millennials remain trapped as renters. These corporations aren't just buying homes randomly. They're using sophisticated algorithms to identify the most profitable markets and swooping in before millennials can even get pre-approved for mortgages. The result? Homeownership rates for millennials are 8% lower than previous generations at the same age, despite having higher education levels and initially higher incomes. The student debt trap. The student loan crisis isn't accidental. It's a carefully orchestrated wealth transfer from millennials to financial institutions. Universities raised tuition costs by 1,200% since 1980, knowing that easy credit would enable students to pay these inflated prices. Meanwhile, Wall Street securitized these loans, creating investment vehicles that profit from your debt payments. Federal loan servicers deliberately complicate repayment processes, making it harder to qualify for forgiveness programs or income-driven repayment plans. They profit from confusion and default, earning fees for every missed payment and restructuring. The average millennial graduates with $33,000 in debt, but after interest and fees, many will pay double that amount over their lifetime. The retirement scam. Wall Street convinced employers to abandon pension plans in favor of 401k accounts, shifting investment risk from companies to individual employees. This wasn't about giving you more control. It was about generating massive fee income for financial firms. The average 401k account loses 2 to 3% annually to management fees, advisory fees, and expense ratios. Most millennials won't accumulate enough retirement savings under the current system. Wall Street knows this, which is why they're already positioning themselves to profit from the coming retirement crisis through reverse mortgages, annuities, and other high-fee products targeting desperate seniors. The credit score manipulation. Credit scoring systems are designed to keep millennials in debt, not help them build wealth. FICO scores reward carrying debt balances and punish paying off loans early. The algorithms favor older accounts, immediately disadvantaging younger borrowers. Credit card companies target college students with predatory offers, knowing that early debt habits will generate decades of interest payments. The three major credit bureaus sell your personal financial data to lenders while simultaneously charging you to access your own credit reports. They profit from both sides of every transaction, creating conflicts of interest that don't serve consumer interests. How to fight back and win? First, bypass traditional banking entirely when possible. Use credit unions for loans and banking services. They're member-owned and typically offer better rates with lower fees. Consider peer-to-peer lending platforms for personal loans instead of traditional banks. Second, invest in low-cost index funds rather than actively managed mutual funds. Vanguard, Fidelity, and Schwab offer funds with expense ratios under 0.1%, compared to 1 to 2% for typical Wall Street products. This difference compounds dramatically over decades. Third, pursue house hacking strategies to enter real estate markets. Buy a duplex, live in one unit, rent out the other. This allows you to build equity while someone else pays your mortgage. FHA loans require only 3.5% down for owner-occupied properties. Fourth, Maximize tax-advantaged accounts before taxable investments. Max out your 401 patch, contribute to Roth IRAs, and use HSAs as retirement vehicles. These accounts shield your growth from Wall Street's favorite profit center, capital gains taxes. Fifth, develop multiple income streams that don't depend on traditional employment. Freelancing, side businesses, and passive income sources reduce your vulnerability to corporate layoffs and wage stagnation. The cryptocurrency opportunity. Despite Wall Street's growing efforts to co-opt cryptocurrency, the core of crypto still represents a powerful parallel financial system, one that operates outside the control of traditional banks and centralized institutions. Cryptocurrencies like Bitcoin and Ethereum aren't just speculative assets. They offer a hedge against inflation, currency devaluation, and centralized monetary policy. Their decentralized nature is what makes them so valuable in the first place. However, investors should be cautious of Wall Street-managed crypto products like ETFs and custodial platforms. These instruments reintroduce centralization and control, undermining the very principles that make crypto revolutionary. By wrapping decentralized assets into Wall Street's infrastructure, they dilute crypto's independence and expose it to market manipulation through derivatives and paper trading. Instead, take a grassroots approach. Use dollar-cost averaging DCA to slowly build your crypto holdings over time, reducing risk and emotional decision-making. Always follow one of the golden rules of investing. Never put in more than you can afford to lose. Building generational wealth. The ultimate victory over Wall Street isn't beating them at their own game. It's building wealth that operates outside their system entirely. True financial freedom comes from owning assets that generate consistent cash flow, not just chasing stock market gains. Rental properties, dividend-paying stocks, and income-generating businesses are prime examples. These assets create income streams that don't depend on a paycheck or market volatility. One of the most powerful moves you can make is starting a side business, even on a small scale. Entrepreneurship gives you control over your income, flexibility, and massive upside potential. Unlike traditional employment, a business can scale, offer tax benefits, and build long-term value. Many millennial millionaires didn't get rich from Wall Street. They'd built their wealth through online ventures, service businesses, or digital products. This mindset shift is key. Instead of relying on a financial system built to serve big institutions, focus on creating systems that serve you. Build assets that pay you regularly. Use tax laws smartly. Keep growing your knowledge and adapting. Wealth that's built through independence and ownership not only lasts, it's also untouchable by the fluctuations of Wall Street. Wall Street may have declared war, but millennials aren't backing down. Which of these tactics are you ready to try? Or do you have your own strategies to fight the system? Drop them in the comments. Let's build a smarter, stronger financial generation together. And if this video gave you a boost of confidence or clarity, don't forget to like, subscribe, and share it with someone who's ready to take control. Until next time, stay sharp, stay focused, and never let the system write your story.